Hey, it's Ty with Credit Suite, and in this short video, I want to introduce you to something I call the 3C cash acquisition formula. This is a really easy way to determine if you or somebody else can actually qualify for business loans. So our partners use this all the time to know within seconds whether or not a customer can qualify for a loan and what kind of loan or credit line they may qualify for. It's super simple once you learn it. So let's dive in. Here's how it works. There are three criteria that lenders mainly look at to determine if a borrower should get approved for a loan or credit line. Now, don't get me wrong, when it comes to fundability, the things that help people qualify, there's like 125 fundability factors. But when it comes down to the main things that will help somebody qualify, there's three main things. Now, people don't have to have all three of these. If you have all three, you can get an SBA loan. But if you don't have all three and only have one, then you're able to qualify without the other two with specified lenders. So a lot of lenders in the fintech or the alternative lending space offer funding that focuses on one of these three C's. And if you have one C, then you can go to that lender and be able to get a loan or credit line. Again, the more C's you have, the more financing opens up. And when you have all three, you're able to get SBA. So let me give you a deeper dive. So first of all, let's talk about cash flow. If you have cash flow consistent in your business, and you can verify it per bank statements, your bank statement shows your deposits. It shows you manage your bank account wisely. It shows your revenue is consistent, maybe even increasing. Then you can actually qualify for financing like merchant cash advances or revenue lending. You can even maybe qualify for peer-to-peer lending. Now, if you have tax returns that show you're profitable, well, then that opens up private money. It opens up alternative lenders that focus on long-term loans. It opens up SBA loans as well. So if you can verify your cash flow is consistent, then there's a lot of lenders that will lend you money based on your cash flow only. Now, the second C is good credit. If you have good personal credit or a guarantor, a family member, a friend, something like that, who will actually sign as a guarantor, then you can use your credit or that person's credit to qualify for financing. You're able to get credit lines up to $150,000, no doc financing, 0% rates, take the cash out, and get credit lines that help you build business credit. It's one of the best programs I've ever seen, and it works really well with startups. Now, remember, if you have cash flow, you can get cash flow financing even if your credit's bad. And if you have good credit, you can get credit-based financing even if you have no cash flow. That's the brilliant thing about this formula. You only need one C, not all three. Now, the third C is collateral. If you have some kind of asset that can serve as collateral, that opens up the door for financing. Now, when we look at all the funding programs available, this is the biggest category. This is where the vast majority of loan programs sit. So for example, you can get account receivable financing or purchase order financing if you need to fulfill purchase orders, or you want to let your customers pay you on terms and you want to use that as leverage to get financing. That's called account receivables. You can get equipment financing, equipment leasing, or borrow against equipment you already have with equipment sale leaseback. If you're an insurance agent, you can get book of business financing. If you have commercial real estate or commercial vehicles, you can get financing for them or borrow against those and actually take money out. Okay, you're able to use personal homes as collateral, stocks, bonds, IRAs, 401ks, inventory. Most assets that exist can be used as collateral to qualify for some type of financing. And this is really low interest rate financing. As a matter of fact, the interest rates on this kind of financing are even better than what you're going to get with an SBA loan. And remember, if you have collateral, you don't need to have good credit and you don't need cash flow. And remember, if you have cash flow, you don't need good credit and you don't need collateral. And remember, if you have good credit, you don't need cash flow and you don't need collateral. So to get money for a business and to qualify a customer for money for a business, they just need one of the C's. Do they have consistent cash flow, verifiable per their bank statements? Or do they have some kind of asset that can serve as collateral? Or do they have good personal credit or a guarantor that does? If the answer is yes to one of those, there's a very good chance they can qualify for financing, or you can qualify for financing. And if they have two or more, well, then they can qualify for more alternative lending, long-term loans, higher lines of credit. Or if they have all three, that's when you get in and qualify for an SBA loan. So now you know the 3C cash acquisition formula, and you can qualify yourself or customers to determine if they can actually get a business loan or credit line.